Your group chat is having a moment right now. Someone's uncle posted a chart. Someone's coworker whispered recession in the break room like it's a curse word. And somewhere between the gas station price sign and your 401k app, you started wondering if you're supposed to be doing something about this. Here's what actually happened. Iran and the U.S. traded strikes near the Strait of Hormuz this week, the narrow stretch of water that roughly a fifth of the world's oil sails through. Oil jumped past $75 a barrel almost overnight. Wall Street did not love that. The Nasdaq had its worst day in weeks. If you checked your retirement account and felt your stomach drop a little, I want you to know exactly which parts of that reaction deserve your attention, and which parts are just noise, dressed up as an emergency. Here's the plain version, no jargon. Oil is priced globally, and a huge share of it physically has to pass through that one strait to get to ships. Iran announced steep new tolls on cargo moving through it. And for a moment, some tankers stopped moving through entirely. Less oil flowing, plus real fear about even less flowing later. And the price jumps. That part is just supply and demand. Higher oil prices ripple out fast. Shipping costs more. Manufacturing costs more. Basically, anything that touches a truck, a plane, or a factory gets a little pricier to produce. Investors look at that and think, inflation might tick back up, and investors hate surprises to their inflation math almost as much as they hate the inflation itself. So, money moves. Some of it leaves stocks that get hurt by rising costs. Chip companies, anything import-heavy, anything running thin margins already. Some of it flows into oil and gas companies because obviously they're having a great week. And some of it just sits in cash for a few days, while everyone figures out whether this is a one-week story or a one-month story. Nobody drained your 401k. Nobody erased your money. A percentage of the value of the stocks you own dipped for a few days because a lot of other people's money moved at the same time yours was sitting there. But the plain mechanics of this really are that boring. The part actually worth 15 minutes of your time is what happens next, and who benefits from you panicking about it. Here's the version with more texture, because it's normal, don't worry about it, isn't useful without evidence. This is not the first time a Middle East conflict has spiked oil prices and spooked the market in the same week. It happens on a fairly predictable rhythm. In 1990, when Iraq invaded Kuwait, oil prices roughly doubled within months, and the S&P dropped around 20%. That recovery took most of a year. In 2019, when a drone attack knocked out a huge chunk of Saudi Arabia's oil production overnight, the single biggest supply disruption in decades at that point, oil spiked nearly 15% in a single day. The stock market barely blinked and was back to normal within about a week. Two similar headlines, two completely different outcomes. The difference wasn't the size of the oil spike. It was how long the disruption actually lasted, and whether it touched the broader economy or stayed contained to energy markets. Which brings us to right now. As of this week, oil sits in the mid-70s per barrel. Tankers are still moving through the strait under new restrictions rather than a full shutdown. And the Nasdaq's drop is being driven less by the economy is collapsing and more by chip stocks specifically getting hit, since a lot of chip manufacturing runs through the region, and companies hate uncertainty more than they hate a one-time cost bump. So far, I want to be honest about that phrase, because anyone promising you they know exactly how a live geopolitical situation resolves is selling you something, not informing you. Nobody, including me, can tell you with certainty whether this cools off in a week or drags into a genuinely rough quarter. What I can tell you is what the data shows about people's money during weeks like this one. The people who came out fine in 1990 and 2019 weren't the ones who correctly predicted which kind of shock it would be. They were the ones who didn't touch their accounts either way. The people who got hurt weren't the ones who owned stocks during the dip. They were the ones who sold during the dip and bought back in after it recovered. paying that panic tax on both ends. I did this once, years ago, with a much smaller amount of money and a much bigger sense of doom. Watched a bad week turn into a worse decision, sold at the bottom, felt very smart for about 4 days, and then watched it recover completely without me in it. That one mistake taught me more about investing than any class I ever took. Let's get specific about your money because the market isn't one thing. It's an average of millions of individual accounts that all look completely different. If retirement is 15, 20, 30 years away for you, this week doesn't belong in your financial decision-making at all. Not because it doesn't matter, but because by the time you actually need this money, this week will be one blip on a chart with dozens of other blips just like it, most of which you've already forgotten happened. If you're within 5 to 10 years of retirement, it's worth a slightly closer look. Not a panic, a look. This is exactly the window where a financial advisor or a target date fund starts shifting your mix toward more bonds and less stock exposure automatically. Specifically so, a week like this one doesn't wreck a retirement date you're close to hitting. If you haven't checked whether your allocation still reflects your timeline in the last year or two, this is a good nudge to check it. Calmly, not this week specifically. And if you've got money you need in the next 1 to 3 years, a house down payment, a wedding, whatever it is, hear this part clearly. That money should never have been sitting in the stock market to begin with. Not because of this week, because of every week. Money you need soon belongs in a high-yield savings account or something boring and stable, not exposed to whatever Tuesday decides to do. Here's the number that matters more than the daily percentage everyone's staring at. How much of your invested money sits in the exact sectors hit hardest by the shock versus spread across everything else? If your whole portfolio is one tech fund and a single semiconductor stock your cousin recommended, yeah, this week probably hurt more than it should have. If you're in a diversified mix, index funds, a target date fund, something spread across sectors and countries, the real damage to your total number is smaller than the scary headline percentage makes it feel. That gap between how bad it feels and how bad it actually is where almost all the anxiety in weeks like this one lives. And it's also conveniently exactly where a certain type of content creator makes their entire living. Let's talk about the people whose entire business model just had the best week of their year. You know the ones. Most weeks, nothing happens, and that video quietly gets deleted or buried. Here's what that content actually sells. Fear is a genuinely excellent business model on this platform. It gets clicks faster than calm ever will, because your brain pays attention to threats far more urgently than it pays attention to reassurance. So, a whole ecosystem of finance content exists specifically to manufacture the feeling that something is about to go very wrong, because that feeling keeps you watching, keeps you subscribed, and in a lot of cases, keeps you one video away from a newsletter, a course, or a get-out-before-it's-too-late trading signal they happen to be selling. I'm not saying dismiss real risk. Real risk exists, and I just spent the last several minutes walking you through exactly how to evaluate it for your own situation. I'm saying be deeply suspicious of anyone whose content requires you to feel panicked in order to keep watching it, especially when that panic conveniently resolves with a product they're selling. Nobody's building a personality around being boringly correct. But boringly correct is what actually builds wealth, and dramatically wrong with great production value is what builds a following. Those are two different goals, and only one of them is trying to help you. The people I trust with this stuff, and the approach I try to bring to this channel, don't need you scared to keep you around. They need you informed enough to make one calm decision and then go live your life. So here's what we're actually doing about it, not reacting to the headline. Responding to your specific situation on purpose. First, close the app for a few days if you're checking it daily. Staring at your 401k balance hourly doesn't change the outcome, it just adds free stress. Checking once a quarter is genuinely enough for most people, at most life stages. Second, confirm your time horizon before you confirm your panic. If this money isn't needed for over a decade, this week doesn't require a decision from you at all. If it's needed sooner, that's not a sell now signal either. It's a signal to check whether it should have been in the market to begin with. Third, check your actual diversification, not just your gut feeling about it. Look at what you're really holding. If a huge chunk sits in one sector or one stock, this is a legitimate moment to rebalance towards something more spread out. Not because of this week specifically, but because this week revealed the concentration was already a risk. Fourth, if you don't have an emergency fund yet, let this be the nudge. 3 to 6 months of expenses in something boring and liquid means weeks like this one. Never force your hand on anything, market-related or otherwise. That fund is the entire reason you get to sit calmly through a headline like this, instead of needing to sell something to cover a bill. Fifth, if you're already investing, keep it on the same schedule. If you dollar cost average into your 401k every paycheck, a dip means those same dollars buy slightly more than they did last week. That's not a consolation prize. That's the mechanism working exactly the way it's supposed to. And sixth, mute the doom. Unsubscribe from whoever needs you scared to keep you watching. Your feed isn't a required reading list, and your financial decisions get better, not worse, when they're made without a countdown timer and a red arrow graphic pressuring you into them. None of this requires you to be a genius about geopolitics or oil markets. It requires knowing your own timeline, your own allocation, and your own emergency fund, and trusting that boring plan over whatever the loudest video in your feed is telling you to feel today. So, your group chat, your coworker, the chart your uncle posted, none of it was wrong exactly. Oil did spike, the market did drop. That part's real. What wasn't required was the sense of emergency wrapped around it. That part gets manufactured, sold to you, and profited from by people whose whole business depends on you feeling one bad week away from disaster. You're not behind. You're not doing this wrong. You checked an account, felt a completely normal reaction to a number going down, and now you know exactly which parts of that feeling deserve a decision and which parts deserve absolutely nothing from you. If this kept you from making a panicked decision this week, subscribe. The market's going to do this again, probably more than once, and I'd rather you hear it from me first than from whoever's selling fear this time.